Hi, I'm Keith McCullough, and welcome to another Hedgeye Investing Summit. I was just looking at some of those pictures. I mean, I used to have not white and gray hair. There used to be a bull market. Now we got another bear market. We've done this many times. Every time it's a lot of fun. And to start this conversation, I get to have a nice conversation with a nice cuddly mama bear by the name of Stephanie Pomboy. One of my favorite people because you can have fun with Parish, and I really look forward to our conversation here, and have looked forward to throughout the last couple of weeks. Really, I've been looking for some friends, frankly.
Well, it's a pleasure to be with you, and growl right back at you.
Well, isn't it like, I mean, it's actually kind of funny that we can have so much fun with it, I think. I mean, is that partly, I know what it is for me, but I mean, for you, it's just certainly not your first rodeo. You've called, again, there aren't that many of us that have actually called the last couple. And this is the third, like if you go back 25 years. Are you having, like, is it enjoyable this time?
I mean, I hate to sound like such a ghoul, but it is enjoyable just because you can line up the dominoes and then identify how the first one's going to fall over and what's going to fall over next and next and next. And it seems so clear to me. And what's fun about it is watching how offsides the market gets, and it seems oblivious to so much of what is, in my view, very clear in terms of where we're headed. But then again, like you said, we've been doing this for a long time, so it's not surprising that the consensus is offsides and that the Fed once again is offsides. So I mean, lather, rinse, repeat, and here we are.
Yeah, it's. I mean, let's do both, because you've done both. Let's do the 2001 period. Again, seasonal dynamics of the stock market in particular are very similar. And then, of course, we'll do '08, which I think on this day it was Ben Bernanke himself in '08 in April that said, if we have a recession, it'll be like a mild one, right? So to your point, track record intact at the Federal Reserve. But yeah. In most of your recent writings, you've been alluding more so to '08. I know every cycle is different, but maybe take a step back to that point and keep us in this point and try to maintain those same thoughts.
Well, I guess when I talk about how this downturn is going to be equal to or worse than 2008. I use that as a framework just to kind of give people a sense as to how significant it could be. But like you said, every cycle is different. But ultimately, what it all comes back to is the amount of leverage that's been built up into the system that is going to have to be unwound on the back of all these rate hikes that the Fed has undertaken. And what's particularly unique about the current cycle is obviously the speed and magnitude with which the Fed has raised rates on an economy which is now toting twice as much debt as going into the global financial crisis. And, you hear routinely these throwaway lines like, yeah, but consumer and corporate balance sheets are strong. Well, when you dig beneath the averages, that's not true at all. In fact, the household balance sheets, okay, they're not as bad as they were going into 2000, into the housing bubble bust, which actually started back in 2006. But the corporate sector is really in rough shape, but it's obscured by, again, the law of averages. So people tend to miss what's going on in terms of the skew between the haves and the have-nots in the corporate sector. And I think all of that will become plainly evident. But I'm not sure, how far into that you want to get, Keith, because there's lots to talk about on that score. But generally, my sense is just, when you take an economy that's got twice as much debt as it did going into the global financial crisis, and you raise rates on it in unprecedented fashion, you're going to cause major dislocations. And the idea that we are going to have some soft landing or no landing or whatever is just absolutely laughable. And the idea that, it was just SVB or it's just the regional banks and it's just commercial real estate reminds me very much of Ben Bernanke's isolated and contained comment, which I think was in 2007 when the asset-backed commercial paper market started to come unglued. And of course, that was just the beginning of lots of fun and games.
Well, I do want to go down like each of these paths. I prefer to go down the bull paths, because we're going to lock arms here. You got Mama Bear, Papa Bear are coming after you. We know what your talking points are. They're widely disseminated. They generally have to do with the average of things. It's not how I do macro. If you take a fractal approach, Mandelbrot 101 is it's the particular thing that happens at the particular time in cycle time, and we're in that time, in that window of clock time. So I want to do that both on the consumer side and on the corporate side, because I think both are really important places where one in particular, the corporate side, was really, now everybody evidently knows that that commercial real estate is contained, but no one called it a risk like 6 months ago. So, let's start with that one, because I get that a lot. Like, I'll be on an institutional client call like you do, and they'll say, well, I hear you. Guys, show slide 51 of this slide deck. Yeah, what's a $1.4 trillion amongst friends? Just a casual $1.4 trillion in maturities, coming due here. Isn't that just like unique to that, Keith? I can't laugh because it's an institutional, client. What do you say to that? Let's just start with that one.
Well, the idea that it's just the commercial real estate market is a joke. The Fed had this free money bonanza going on for the better part of the decade that followed the global financial crisis. And obviously, everybody took advantage. And there are people who took more aggressive advantage, and that's starting to become made clear. So what you're seeing, as you always do, is the weakest links in the chain break first. But that doesn't mean that the rest of the links are intact or are going to stay intact. Inevitably, all these problems bleed out. As I just alluded to, back in 2007, you started to see the asset-backed commercial paper market start to come unglued. And again, Bernanke said that was isolated and contained. And it turned out that the problem of excess leverage wasn't simply in that sector of the market. It was everywhere because, again, the Fed, as it has done now, presided over interest rates that were held too low for too long, and everyone took advantage. And why wouldn't they? So that would be my response is, give it a minute. If you think it's just commercial real estate, just wait a second, because this is clearly going to devolve in a variety of ways. And frankly, I mentioned it earlier, the corporate credit market is my primary concern, just because numerically we're facing even more of a maturity wall in the immediate future here in terms of paper that needs to roll. And, if you were a junk borrower and you were borrowing at 4% a year ago, now you're borrowing at 8.5%. So that's a problem. And I don't think anyone's focused on that. And there are a number of places we can cite. You mentioned the consumer. Obviously, we're already seeing delinquency rates rise there, both in credit cards and auto loans. And, this whole buy now, pay later thing is not surprisingly turned out to be a complete disaster. So, I like to use the title, I never saw the movie, but Everything Everywhere All at Once, in terms of the impact of this higher interest rates on an overly levered economy across every sector.
It's interesting on the, let's do parts of different sectors. Let's just do, which you'll know really well, guys, pull up slide 73 to get her response. I'm showing the Senior Loan Officer Survey C&I lending cycles. Now, I'll be damned if I don't think it's an optical illusion here, Steph, but there's only 3 bars with the pink, of this current juncture. Looking back at these other cycles when money was free, it looks like there were more bars, and it looks like they went a lot lower. Didn't they go lower?
Yeah, absolutely. The
Doesn't that just stop because Jamie had a good quarter?
Right? Silly me. I should have figured that out, right? It's all is good. God is dead. Everything's permitted. It's we're back. So no, it is, again, it's one of those things where you have to admire their optimism, I guess would be the way to put it. This eternal optimism that says, well, this time it'll be a shorter and shallower hit from the tightening of credit conditions. So, I enjoy it. Getting back to your question at the top, Keith, because it's sort of like if everyone grasped the magnitude of what we're going into right off the bat, and the markets just did a complete flush, it would just be quick and we'd be through it. But it's this refusal to acknowledge the reality staring them in the face that creates this long grind where you have the market rally on this hope that things are going to actually not be that bad, only to get punched in the face with, the next SVB or the next, PIMCO commercial real estate default or whatever is around the corner. And it kind of makes for an entertaining spectacle.
Well, it is in the sense that you have, I don't know what it is. I mean, there's the willful blindness. That's one thing. That's kind of funny, but not really. Then there's the arrogance of assuming that it's just one thing because you just realized there was something that you didn't realize before. And then you have I think you've called it the everything bubble, correct? I mean,
yes,
wrapped all around it, and all this kind of behavior that many wouldn't know like, to me, it's almost like there are a lot of different things there, right? I mean, the ignorance part, you haven't seen a cycle, you don't know what even C&I loans are, you're just buying like YOLO Tesla options. That's what you do. I mean, how about the behavioral component of that bubble?
I mean, it's fascinating. All kidding aside, I mean, I think a lot about this because in the time that I've been in the business, you and I have been at this about the same length of time, the nature of the business has changed a lot. I'm old enough to remember when hedge funds were actually hedge funds. They had long positions and short positions, and I actually, back in the day, covered at Fidelity, Jeff Finnick, who famously actually bought treasury bonds in the Magellan Fund because he was so concerned about the stock market. And he held cash, but then he also bought bonds. So these are things that no longer exist in the current investment universe. I mean, first off, you could never buy treasuries in a mutual fund that was an equity fund to begin with, much less, hold any kind of cash. But so the whole business has changed to be predisposed toward long only. And I think that's just a consequence of this binary Fed policy where, they are very slow and late always to raise rates. And then on the other side, they rush and cut and hold them way too low for way too long. And so the market has, been trained that basically you're never going to have any sustained downturn. You just always want to be long. And hedge funds, why would they hedge against, something that's really never going to happen? So not only do you not want to hold a hedge or hold cash, you want to be long, but that's not enough. You got to be long on leverage. So, I mean, this whole business is sort of perpetuated by bullish sell side research that helps, justify the long only exposure that really ultimately at the end of the day has been created by this decades long policy of the Federal Reserve of just rushing in with the fire hoses every time the market stubs its toe.
It's a fascinating thing, but the damn thing won't change. The gravity being, I mean, yes. Having a willful blindness to how cycles play out. That C&I loan, that cycle is happening. Like you can't just take that away. And in fact, now we don't have the Fed coming to the rescue. We have the Fed still tightening. Don't forget. So it's it's the worst setup I think ever. But there are causal relationships that fall out of that. Let's just go to that. Go to slide 53, guys, where the two things that, let's go to the consumer, which you've already called out, which I wanted to get to. Jobless claims on the left, the relationship between the C&I cycle leading the loss of cash flows and your job, and then on the right side, the CapEx cycle. I mean, these are, to you and I, these are trivial facts. I mean, it would have to be entirely different this time. I mean, gravity would have to be. How
Right.
do you answer to that when you're having conversations? I think it's hard to do.
Yeah. Well, I think what it comes down to, and maybe I'm imposing my own view on it, but I think there's this expectation that, okay, well, the Fed's going to pivot because that's what they do. And therefore, you're going to have an easing of the credit conditions in the not too distant future. And therefore, this cycle will be more compressed, and the CNI lending thing really is going to be shorter this time and doesn't have the same, forecasting record that it did in the past. And of course, I totally disagree with that, in part because I think, there's the credit quality issue that cannot be solved, even if you assume that the Fed is going to pivot. They would have to, as far as I'm concerned, cut rates all the way back down to where they were before they started to raise them to avert a default cycle. Because as I mentioned earlier, if you were borrowing at 4%, and now you've got to pay 8.5%, there is a huge swath of borrowers that can't do that. So you're going to have a default cycle. As I said, you're already seeing it in the consumer space. You'll see it in the corporate space. We're seeing it in commercial real estate. And that will tighten credit conditions irrespective of what the Fed does. So, that's one pushback. The other one, we could have a whole conversation about this, is the Fed really going to pivot after having said higher for longer repeatedly, and Powell trying to prove that he's Volcker 2.0. If he rushes in and cuts rates, what about preserving that legacy that he's so desperate, I think, now to preserve? That's another whole conversation. But I think this entire optimism, getting back to your broader question, rests on this notion that we're going to get a pivot, and therefore the Fed tightening's over, and you need to position for the accommodative policy that is necessarily going to follow.
Well, on that, I was just looking back to make sure that, because I was with my wife and daughters on spring break, but Powell called it, and I quote, on the 13th of April. Oh, look, he used the same word as Bernanke. A mild recession later this year, though. So that's his forecast. So can we?
Right.
So let's get into that. Like, he's going to stay the course, but he's also going to stay with his forecast, which leads him to that course.
Absolutely. Right.
But you and I have a forecast. Like, my forecast for, you guys go to slide 14. My forecast is currently that we're going to have a -2 GDP this quarter. So can you go through that? Like, how? Because I know you're well-known Fed critic, but for the right reasons.
Well, I totally agree with you, by the way, on this quarter. I think the speed with which the data fall apart is going to catch a lot of people by surprise. I mean, obviously, I don't need to tell you about how the first quarter was inflated by the typical seasonal factors, but then also we had one of the warmest winters in history. I think January was the 6th warmest and February was the 3rd warmest, or vice versa, in 129 years. So all of that conspired to inflate the data in the first quarter, and the second quarter fall off is going, I think, to be dramatic and catch people by surprise. So I agree with you. I think the Fed, not surprisingly, their forecast sucks and will be completely wrong, as it is every single time. And yet they're harnessing their policy, obviously, to this forecast that's always wrong. So their policy, as ever, will be wrong again. So, we just watch them make the same mistakes they always make. But they, this again gets into the philosophical question: is it willful ignorance on their part? They must know that seasonally the first quarter numbers were inflated, and that we're going to head into this fall off in the second quarter. They must know that. So are they trying to game confidence? Are they trying to not scare people by having a softer forecast or forecasting a severe recession? I don't know. I can't get inside Jerome Powell's head. Frankly, I never thought he'd raise rates as quickly and dramatically as he has. So my head's spinning about what this guy's all about.
Well, regardless, back to your point, of the prior two experiences you and I had, like, as a practical matter, like, we had to make money through it, we had to write about it, We had to have forecasts, like accurate ones. But,
Yeah.
in both periods, coming into the 2001 period, Greenspan went turntail dovish and cut rates, and obviously Ben Bernanke went epically dovish. And that thing that every hedge fund client in particular asks me for, which is when does the cowbell come? I mean, that's when the bell tolled. I mean, those were not positive catalysts. It's actually, isn't it when the Fed actually realizes that we're in a recession?
Yeah, I mean, absolutely. The idea, right, that this is another thing that I keep being puzzled by, this idea that the pivot is this Pavlovian signal that you should buy. The catalyst for a pivot, especially after they've talked about higher for longer, is going to be something so ugly that you're not going to want to be long. You're going to be really trying to hit the sell button on everything at that point.
I mean, like that's why you said the Fed couldn't forecast wind in a hurricane. I think you've said that.
Yeah, exactly right.
It's good.
Oh
now let's take it to the next part, which you've written about extensively as well, which are grossly inflated expectations on earnings. Now, it's one thing to get the cycle right. It's another thing to understand that thing sleeps with like the corporate profit cycle, and that's the real thing going on here. So you and I understand that. Maybe not everyone watching this understands that, or maybe they're not paid to understand that. There's two different things, right? So
right.
Can you go through where you think, I mean, guys, show slide 62 where next 12 months earnings. I mean, this is the joke beyond jokes, in terms of like, what are we, 2 to 5% off the mother of all-time highs, which include the funniest money you could ever have, plus the government handouts. I mean, this is beyond absurd. How absurd do you think and then you'll hear every day the clown show that is CNBC. They'll say, "Oh, it's better than expected."
Right.
Like, dude, God. NASDAQ has had 6 companies out of 100 report negative earnings of 72% year over year. I don't know who was expecting that was along the NASDAQ last year, but it's not many. So can you go through your view on the earnings cycle?
Well, and forget about guidance, which has been overwhelmingly negative. But so there are a couple things on the profit thing. First, I like to look at a very simplistic proxy for corporate profits, and that is the CPI, which is consumer prices, versus the PPI, input prices. And that's basic, kind of a proxy for profit margins. So what are you paying for your inputs versus your ability to pass those prices along? And during this great inflation surge, input prices went up so much faster than consumer prices. I mean, everyone was myopically fixated on the CPI and completely ignored what was going on with the PPI. And meanwhile, behind the curtain, corporate margins were getting absolutely pressed to the bone. And there were a handful of companies that were able to pass on some of their input costs, but not all of them. And that's become really evident in the consumer-facing sectors. But what's amazing to me is that, like you said, the expectations are still pie in the sky. I mean, I think earnings estimates for the full year S&P are like minus 2% by the end of the year after, as you said, ridiculously inflated earnings numbers for the year prior. But what's stunning to me isn't even that number. It's what's contributing. Consumer discretionary earnings are forecast to be up over 10% this year. Financials are going to be up, I think, 8.5% is the estimate, and real estate is going to be up another 8% or something. So I don't know what they're smoking out there, but these numbers just make no sense to me. I mean, the 3 areas I wouldn't touch with a 10-foot pole are the 3 areas that the analysts are most bullish on in terms of earnings forecasts. So you're asking the wrong person if you're looking for answers as to what they're coming up with there, because I have no clue how they come up with these forecasts. Nothing I see suggests that we're going to see earnings growth. In fact, I was looking at just the inventory cycle alone, as that's another topic you and I can talk about, is this unprecedented inventory build that we've had. And we 2 years in still haven't really made much progress in drawing that down. That's going to be accomplished through massive discounting And the last several inventory cycles we saw resulted in a 22 percentage point swing in profit growth, 22 percentage points from the peak of the inventory cycle. So based on that, we should be looking at least minus 14% earnings growth this year. And that's just based on the inventory cycle. Forget it, layering on the credit bubble bust, the tightening of credit conditions. So anyway, that was a whole mouthful there.
No,
sorry.
that's it. But you know what? Everything that comes out of your mouth is within it's an empirical fact. This is why Steph goes first, because she can forget more on the way to the bear cave than most people that can tweet, and everyone can, will ever know. Okay. And it's an important thing, to understand these relationships. The one that she just called out, we have it on slide 39, guys. Inventories, looking at inventories versus backlogs and the leading indicator that was embedded therein. I mean, that was a bubble. I mean, every single component of earnings was a bubble. So so you're saying down 4. I actually have a really hard time, Steph, getting to. I'm better than bad at nowcasting real GDP growth and headline inflation, but I struggle with where the bottom is on the rate of change of S&P 500 earnings growth. I mean, in other words, I know I'm going to get it wrong, but I'm going to get it wrong because I'm too high. If you go back to the two coming out of the last growth bubble, as you well know, S&P earnings had a 45 to 50% drawdown.
I was going to say 50%. Yeah, something like that. Yep.
And now they're down 5?
I know. Right. But we're done.
Yeah, it's all priced in.
Right. Absolutely.
It's priced in.
Well, yeah. Earnings are surprising on the upside, as you said. So obviously we've done all the homework and we should be good.
Well, this is, guys, it was slide 60, by the way. I mean, when you call it the everything bubble, I call it the mother of all bubbles. I go #Moab. It's like, isn't everything that is a bubble that is now identifiably I can't own, like commercial real estate, just part and parcel, a function of those trailing cash flows?
Oh, 100%. I mean, that's why I keep coming back to this idea that, you can't just focus on commercial real estate or the consumer and say these little things are isolated. I mean, again, this is the fruits of unprecedented accommodation that have built up forever. And people made the mistake of looking at earnings and believing that they were somehow separate from this froth and all the leverage that was created. And that's particularly problematic when it comes to S&P earnings. Yep. I like to look at the government accounting of profits, which, doesn't have a lot of the issues that the S&P earnings numbers do. But the primary problem with the S&P earnings numbers is they're inflated by share buybacks. And that's where a lot of the funny money went. I mean, $1 trillion plus a year in share buybacks will have a pretty big impact on those earnings per share numbers in making them look substantially better than the reality beneath the surface. And that's why I look at, the difference between the S&P numbers and the government's profit accounting. Mm. And since 2016, the S&P earnings numbers are up twice as much as the government profit numbers. So there you go. I mean, it's half of it is just air. Basically.
Yeah, and you're being a nice bear right now, because there's also fraud in the numbers. There's accounting, there's a lot, and that's an empirical fact as well. Once you go to negative year-over-year cash flow growth, even in S&P 500 terms, that's where the rate of change of fraud picks up, because people try to hide the fact that they don't have any money. It's not that complicated for real human beings.
It's not an accident that those guys at Indiana University had this study that said fraud was at the fraud warning was at the highest level since the 1970s in terms of S&P earnings right now. They have some kind of indicator that they look at, and that was their conclusion, was that corporate fraud is the most rampant since the stagflationary 70s, when they were presumably forced to do a lot of this stuff to flatter earnings that were being decimated by the inflation issues that we're contending with again today.
And one other big topic, there are plenty of topics, like you and I could keep going and going. What do you say back, it was one thing to say, well, look at corporate balance sheets. Now look at corporates. Look at the savings rate, Steph. Look at the savings. And now look at it, it's on cycle lows, going to make new all-time lows.
I love that excess saving thing. Explain to me what an excess savings is. I really love that whole thesis. But anyway, sorry.
But it's talking points. Like just Steph and I, if you guys think that your life's tough out there in the audience, try being Mama and Papa Bear out here. We have to answer to all these talking points, and they're everywhere. And the big one that's kind of the last of the Mohicans, which most people who've studied past their nose in economics should know, is late cycle labor as an indicator. So people, but the jobs market, Steph, the jobs market is so resilient, and the consumer this time, it's just different.
Yeah, absolutely.
So what do you think about that?
Well, I was actually thinking this morning, the Fed came out with a study about labor conditions, and it revealed that the minimum wage anyone would accept to take a job had increased another $2,000 over the course of the year or something. So basically, these labor studies are really reinforcing the Fed's idea that the labor market is so tight that they can't possibly pivot, and that inflation is going to remain hot. And I think, like you said, this is talk about rear view mirror. I mean, employment lags in general, but never more so than after you come out of a pandemic where no one could hire people. And when they finally got a couple people to come back to work, what's their impulse to let them go the second things slow down? Probably pretty limited. So my sense is we had this, people talk about labor hoarding. Well, okay, if we had labor hoarding over the last year, because they were desperate to get people, when they finally exceed the reality of what is what we're looking at here in terms of the recession that's coming, I would think that you will see a complete reversal in this labor market where you go from incredibly tight to incredibly slack, because that labor hoarding becomes excess labor, and they just cut all the excess labor in one fell swoop, because as we've talked about, the earnings picture behind the curtain is not very good at all, and it's only going to get worse. And the number one cost of business is labor. So they've been trying to stay tough and just kind of ride it out. But when they discover that what they're going to have to ride out isn't going to be a 1 quarter or 2 quarter phenomenon, but probably maybe a 2008-9, really deep recession, I would think you could see those jobs cut in a hurry. So I think this labor story is going to blow up in their faces, given the speed with which it's going to reverse. And I know that you've got all the charts like I do that overlay things like, housing versus labor and C&I loans versus labor, and, the sharp declines that we've seen in housing activity and credit conditions and whatnot, basically foretell a really sharp reversal in employment as well.
Yeah, if you look, again, for people that actually do this job and do it deliberately and consistently and look at every data set, which is not easy to do. It's got to be your job. Let's just start with that, not just a thought. And a lot of people just haven't called out, including the Fed, which is kind of shocking. Everything from hours worked to temp staffing, anything that's rate of change underneath the hood, or even composite surveys like employment surveys inside of the PMIs. So what you're saying is already happening. What's amazing is the Federal Reserve doesn't start with that, but it's okay. I mean, it's what a bear needs to eat, right? If they weren't going to get this categorically wrong, then where would the upside be for the bears? I mean, I don't know. By the way, if you have questions for Steph, pop them in the queue. I'm going to ask them. We have 10 minutes left here, and you have some fans here, not surprisingly here, Steph. So they have some questions. But my last question before we go to their question is, because you do a great job with all these lead lag relationships, you have your own indicators, obviously, as you've called out, multiple your relationships like the CPI to PPI. Have you done that same thing to labor? This time with labor being. You could say this time, actually you should say this time labor is different in terms of its structure.
Right. Yeah. Yeah, absolutely. I mean, I guess it's hard to compare it to anything because this cycle is unique in terms of labor. and the post-pandemic experience. And then, of course, you get this whole work from home thing, which is another phenomenon. But I guess, the one thing I do look at is every survey on the planet that relates to employment, whether it's the ISMs or the regional Fed surveys, NFIB. And what strikes me is that the payroll survey is the exception to the rule. And the rule is that every other indicator is telling you that you have a softening in employment conditions. The payroll survey seems to be living in a, universe unto its own. And, I do a lot of really nerdy deep dive stuff on the seasonal adjustments in the birth death factor that contribute to this payroll survey, and what you see in the headline numbers. And there's been a lot of fairly dubious stuff going on there, that really, would make your audience's eyes glaze over. But suffice to say, those numbers really don't add up, in my view. And I'm just waiting for that reality to become revealed at some point.
Well, I mean, we've been trying to use I've tried to use every analogy, for God's sakes, at this point. But I mean, like the sinkhole. I mean, the last thing to cave in is the surface, which is the NFP number. And by that time, I mean, I'm expecting, a lot of bulls don't expect this. They're like, oh, that's when the Fed has a green light to cut, Keith. And I'm like, well, it's also when consumption growth can go to zero because people are getting fired.
Well, I love the quip that people make, which is, you never have a recession with the unemployment rate this low.
Oh,
it's like, no, the fact is, the recession always starts at the low in the unemployment rate. It's like, it's pretty much the rule. So, I mean, it's amazing how things get, that saying, if you repeat a lie often enough, it becomes the truth. And they repeat these lies with impunity on CNBC and these places. The consumer is strong. There's all kinds of excess saving. You never have a recession with the unemployment rate this low. The market always rallies right when you start a recession. Well, yeah, but the Fed's not tightening into it when that, it's like there are all these lies that get repeated and are swallowed.
I don't think they know they're lying. I think they're that dumb. Like, I mean, like numb, dumb, whatever word you want to use. I mean, macro unaware, I use that. I use willful blindness. I mean, this is a tough job. If you haven't studied, like you've done it for a quarter century. I mean, I don't want to try to, date you here.
Right. But I know, I'm an old lady. It's like, I get it. The point is made, Keith.
But it's like, it's just, I think that's why we're having more fun with it. I think as a younger man and woman, you and I were probably not you, but definitely me, like quite surly, angry, revenant bear, kind of thing. Like now it's just like when I see this stuff or hear this stuff, you see it because of Twitter. I mean, I'm like, you're just a fucking idiot. I mean, it's just like.
Let me just say what it is. Oh my God. Yeah, no, I'm with you. No, you were almost, I think back in the day, I was almost reticent. Like, wow, I mean, I feel so bearish and, maybe I'm missing it, even though I was doing all this work and coming to this conclusion and everyone else was telling me it was going to be fine. And I doubted myself. Now I have the capacity to actually say what you're saying, but I won't repeat it because I'm a lady. So.
Well, I appreciate it.
Oh my God.
That's why, we have to have this, I think Jocko Willink's new book is called The Dichotomy of Leadership, which is, you have to have some balance. You got to have this. You have to have the mama bear and you have to have the papa bear. So
right, there you go. Papa
bear's Canadian potty hockey mouth, and you got, classy lady.
Well, I don't know how classy, but whatever.
All right.
Lady is true enough.
All right. Well, apparently ladies own gold miners. I did not know this because this question implies that you do. So, Stephanie, love your views. Within the past year, you've revealed that you've had substantial positions in gold and the miners, as have many of us. Have you made any adjustments out of those two areas?
No. Nope. They are core positions in my portfolio. I mean, the only thing that I've changed is to buy some T-bills rather than parking my money in the bank. So that's about it. But yeah, gold miners and long dated treasuries, I'm still interested in that part of the curve, and then some cash.
So
Yeah.
you and I have a very similar setup. It appears. So
I'm not surprised to learn that.
yeah, they used to say, "Gentlemen prefer bonds. Dare you call me one?" The gold's there are a couple questions on gold. So the bulls will say other things like, well, the yield curve being inverted, that's not a leading indicator this time for a recession, or they don't even, once you get them to gold, that can't even be discussed. But this breakout in gold, I mean, it won't be long before we see all-time highs. Has that ever been a bullish signal?
Oh my gosh, no. In fact, one thing that I look very closely at is the gold to copper ratio, which is an indicator of financial versus economic strength, let's say. And it's just another one of these crude barometers that I use. And whenever gold is outperforming copper, it's generally been a sign that you've got some financial ugliness coming down the pike. So yeah, no, I'm with you. Generally, when gold is hitting new highs, it's not a time to be loading the boat with S&P calls or anything like that. Quite the contrary. And we haven't even gotten into this whole conversation about the dollar and ways to hedge around that. But I think, in addition to hedging financial risk, gold obviously serves the other key purpose of hedging against a further debasement of the dollar. Yeah, I love it.
Today's a good example too, and we've had the frequency and severity of days that have had intraday reversals on something monkey like SPYs versus gold. They're starting to add up, i.e., they already are a trend. But anyway, moving along. Actually, we only have time for one more question. Brandon from Charleston. I'm actually going to Charleston soon with my daughter for a hockey tournament.
Oh, lucky you. Fun town.
I am lucky. Because hockey tournaments, you go to like some really nasty spots. Usually this is nice.
Yeah.
But here's a good question because I have to deal with this every day. Stephanie from Brandon in Charleston. Stephanie, how do you risk manage your positioning during these bloody bear market rallies, while waiting for this whole thing to play out?
Well, I'll confess, I don't own any stocks other than gold miners, so that's how I do it. I stay on the sidelines. One thing I did change was that I finally stopped buying puts on the S&P. Every year, I load up on some puts that with like December expiration, because I figure if the market does finally crash, I would be so upset if I didn't have a position on. So I do that, and every year that money just goes up in a puff of smoke. So that's probably why we've been having these bear market rallies here, is that I don't have any puts on. So, but basically, yeah, I have no exposure to the equity market whatsoever, other than via my gold miners, and I view them as sort of an inverse equity market position there anyway. So that's how I hedge myself.
Well, we'll call it the maturation of Mama Bear. I mean, this is like
I'm growing up.
It's like it's our third time, our third one, and I at least I didn't own nearly enough Treasury bonds in 2008. There are a lot more ways to make money than I did in get the direction and the call right, but I didn't know what to do. I mean, now I think I know what to do. We'll have to see. And the same thing with gold. So, I guess isn't that a little bit more fun too, where you don't have to wake up with FOMO? I mean, today, gold miners up 2.2%. Your beloved SPYs flat down, whatever. I mean, it doesn't matter.
Exactly. I go to sleep. I rest very easy at night, owning gold in the miners and no stocks. I feel very good.
Well, you look good. You look about as. I'm trying to get. We have this Hedgeye anxiety meter that we've built, which it's a good little algo. It's not AI because we don't have market cap to trade, so I'm not trying to get people to juice Hedgeye stock here. But this is it is an algo, and I'm trying. And I'm going to try throughout this investing summit, Steph, to get people to how Steph Pomboy looks right now. You look as calm, cool, and collected as any bear, Whereas, like you said, back in our former lives, we're younger, inexperienced, worried that we're going to be dead wrong every day, having bosses tell us we were wrong, which is an entirely bigger problem. A lot of stress, and I want to make sure that people know that. We know that people that don't have experience getting these recessions and bear markets right are stressed out. We know what FOMO is. So I appreciate that you've kind of, well, I mean, you're not kind of, I mean, the way that you've expressed yourself and the way that you just look about it. I mean, it's the nicest looking mama bear that we've seen.
Well, thank you. My calmness and confidence meter is the inverse of your anxiety meter. So when everyone else is nervous, I feel great.
That's awesome. That's why we had you lead off. Thanks for joining me. I appreciate it.
Thank you, Keith. Always a pleasure. Enjoy the rest of the conference. I can't wait to tune in.
Okay. Well, cool. I hope the other bears are as calm and cool and really cool and as collected as Steph Pomboy. Up next, we have Aisha Tariq.